We have seen market failures. We have seen countless business collapses. We have even witnessed financial meltdowns. But when news hit the world that Silicon Valley Bank collapsed, it had every stockbroker shaken. The bank's recent collapse is one of the biggest U.S. bank failures since the global financial crisis and the second biggest bank failure in history. So stay with us in this video as we take you through everything you need to know about the collapse of the Silicon Valley Bank. The bank has over 4 decades of history, so sit tight and get enlightened. The Silicon Valley Bank is, or should we say was, the 16th largest commercial bank in the United States. That's impressive, but what's even more impressive is that this bank held its status as one of the movers and shakers of the banking industry for almost 40 years. The brainchild of a Stanford professor, Robert Medeiros, and a manager of the former Bank of America, Bill Biggerstaff, the bank was created in order to provide for the needs of startup companies. Back in the 1980s, the idea of technology companies was fairly new. This meant that most banks and equity investors didn't want to provide capital because these companies were considered high-risk investments. So to solve this problem, or at least make an effort to, came to the Silicon Valley Bank. The bank was launched on October 17, 1983, as a state bank and Federal Reserve member, with its first office in San Jose, California. The founders, Bill and Robert, hired Roger V. Smith, who had previously worked as the head of the high-tech lending unit at Wells Fargo, to be the president and the CEO of the newly opened bank. The bank was a subsidiary unit of Silicon Valley Bank shares and had 100 investors upon its inception. There were many banks already back then, but what made this one stand out? Silicon Valley's mode of operation. The bank's major mode of operation was networking and marketing. It connected customers to its network of venture capital, law, and accounting firms. At first, the bank collected deposits from businesses financed through venture capital, but it later moved into banking and venture capitalist financing. They also added services to enable the bank to maintain clients as they grew past the startup stage. And as networking goes, a couple of years in Silicon Valley gained new clients through referrals from the old ones. According to the CEO, Roger Smith, quote, unquote, "We promoted and sold our founders group. I never went anywhere in the world that I would not share our founders group that somebody didn't know or know of somebody." Initially, startup founders had to pledge about half of their shares as collateral in order to secure a loan, but the rate later fell to about 7%. That's crazy! But the bank made up for its losses by selling shares to interested investors. You could tell business was going good in the first decade since its establishment. The bank really went from a loss of $39,000 in 1985 to a profit of $1.2 million in 1991. In 1990, it opened its first office on the East Coast near Boston and even diversified into the high-risk real estate loan business, although that wasn't that much of a success. By 1994, the bank had added a winery lending business to its growing portfolio. Fast forward to 1999, and the powers that be of the Silicon Valley Bank decided to go public and were able to raise over $55 million in an initial public offering. This allowed it to expand its range of services and its geographical reach. But this wasn't even half of the success the establishment was going to have. Over the next 10 years, Silicon Valley expanded its presence beyond California and opened branches in other tech hubs across the U.S., including New York and Boston. By the mid-2010, SVB had become one of the most renowned banks in the world, with a reputation for working with innovative companies in a range of sectors. Up until early 2023, the bank had operations in the U.S., Europe, and Asia, and continued to serve as a key partner to many of the world's most groundbreaking companies. One highlight in recent years is how SVB has benefited from the rapid growth of the tech sector. A major part of this is due to the increased demand for digital services caused by the pandemic. If you're particular about the numbers, here are some to crunch up. SVB's assets tripled from $71 billion at the end of 2019 to $220 billion in March 2023. Now that's one hell of a growth sprout. As thousands of tech startups left their cash with the bank, their earnings increased exponentially. Clearly, Silicon Valley Bank was really at the top of its game. But where did it all go wrong? What made one of the largest and most successful banks collapse so badly and so fast, too? It could have been the bank investors who bet $80 billion on long-term bonds that bled value when the interest rate went up, or the Federal Reserve for falling behind inflation and then quickly raising interest rates. Or maybe it's just a combination of all these. A few years ago, like many other banks, the SVB invested billions into U.S. government bonds during the no-interest rate era. It was the safe bet. Everyone and their dogs were hopping on the trend. However, not long after the inflation, the Federal Reserve had to hike the interest rate. There is only one result when that happens. As interest rates rise, bond prices fall. The jump in rates yielded an average of 1.79%, which was far below the 10-year Treasury yield of around 3.9%. At the same time, the hike in the interest rate made borrowing costs higher, so tech startups had to channel more money into repaying debts while also trying to raise new capital. That's as hard a task as it sounds. As a result, businesses were forced to use deposits kept by SVB to pay for operations and expansion. Frankly speaking, though, while this certainly had effects on the bank, it's not reason enough for such a massive collapse. But the policy change in 2021 didn't help matters either. Previously, Silicon Valley Bank was known for making short-term loans, but in 2021, instead of using short-term investments to cover their obligation, they switched to long-term securities. An example of these long-term securities was Treasury bonds to increase yield. Unfortunately, they were unable to sell their possessions without suffering a significant loss, making them insolvent for months. This already meant they had more debts than assets. That in itself was trouble looming in the corners. However, the final straw came when SVB's parent company, SVB Financial Group, announced its need to raise $2.25 billion to secure its finances. It might have been speculated at the time, but officially revealing that the bank was insolvent just took the tension up by several notches. Due to the increased competition and technological advancement in the tech industry, most startup companies couldn't pay their loans. Coupled with the loss from the bonds, the bank was on thin ice. You know what? Maybe the bank could have been saved if its clients had more faith, but they say, hindsight is 20/20. In foresight, we know that after the insolvency issue was brought to light, the Founders Fund and other large investment companies advised their companies to pull out all their cash. Word came out of SVB customers saying CEO Greg Becker couldn't instill confidence even though he urged them to, quote, unquote, stay calm, during a call a day before the full collapse. The stock's collapse continued without stopping, reaching almost 60% by the end of the regular trading day. But to make things worse, Becker couldn't even assure those he had on that call on March 9, 2023, that the capital raise would be the bank's last. Other startups also decided to do the same as the news began to spread on social media. That same day, on the 9th of March, SVB clients altogether withdrew $42 billion. By Friday, the bank ditched its efforts to sell shares as the SVB continued to sink. Rather, it wanted to sell itself. It would be nice to see an investor buy out the bank from its impending doom and hope to build back from scratch, but with the constant withdrawals, that didn't work out either. With the entire financial world with eyes on Silicon Valley Bank, the finances of the company were reviewed by the FDIC and Federal Reserve on that same day, March 10, 2023. And after some hours, the California Department of Financial Protection and Innovation, DFPI, issued an official order taking possession of SVB due to inadequate liquidity and insolvency and appointed the FDIC as the receiver. The FDIC subsequently formed the Deposit Insurance National Bank of Santa Clara to reopen the bank's branches the following Monday and provide access to protected deposits. The precipitous deposit withdrawal has caused the bank to be incapable of paying its obligations as they come due, the California financial regulator stated. The bank is now insolvent. That was it. Game, set, match. The Silicon Valley Bank had collapsed, and it was official. For the few who maintain trust with SVB, there is presently no timeline on when to retrieve their money. While insured deposits were expected to be available as early as Monday, March 13th, the lion's share of deposits held by SVB was uninsured, and it's unclear when they will be freed up. The only thing such customers have is the government's guarantee that all deposits left will be retrieved. Many don't know this, but a bid was actually made for the SVB's assets on March 12, 2023, only to be declined by the FDIC. However, the FDIC plans to hold another auction to attract bids from major banks. On March 13, 2023, the FDIC moved SVB assets to Silicon Valley Bridge Bank and named Tim Mayopoulos as the new CEO. Although the U.S. government has intervened, the bank collapse will definitely affect the global market and maybe even trigger a banking crisis. We hope not, but we'll have to wait and see. Let us know in the comments section if you have any additions or questions regarding this major breaking news. Don't forget to like and subscribe to our channel and enjoy our other videos.